Hi, it is Thursday morning, 24 of July, and it is 8 a.m. in New York. This channel is Drips Media, and I will be covering financial news from New York stock exchanges before markets open. The regular trading for the U.S. stock market opens at 9:30 a.m. My name is Daniela Drips. I will be quickly covering yesterday's closing data, main indexes, and the key companies. Please follow us online.
Good morning. This is Drips Media, lid from New York. Drips Media, the revolutionary digital service that transforms the way you stay informed. With Drips Media, you get real-time news delivered in dynamic short video clips, keeping you updated on the latest headlines as they happen. Our cutting-edge technology curates and condenses top stories. Whether you're on the go or just need a quick update, Drips News ensures you're always in the know, effortlessly. Stay connected, stay informed, and experience news like never before with Drips News.
All three major indices closed in the red today, extending their losses for a second consecutive day. The tech-heavy NASDAQ experienced the most significant decline, tumbling 3.6% to close at 17,342.4. This downturn follows recent gains in the tech sector, potentially indicating a period of profit-taking by investors. The S&P 500, a broader market index, also took a hit, falling 2.3% to finish at 5,427.1. This decline was spread across various sectors, suggesting a general sense of risk aversion in the market. The Dow Jones Industrial Average, composed of 30 large-cap companies, showed more resilience but still closed down 1.3% at 39,853.9. These consecutive losses raise questions about the market's near-term direction. Are we seeing a temporary pullback after a strong run, or is this the beginning of a more significant market correction? We'll be analyzing these trends and more with our expert panel after the break. Now let's delve deeper into the performance of some tech giants, which have been influential in the recent market volatility. Apple, a bellwether for the tech industry, saw its shares decline 2.9%, reversing its previous day's gains. This pullback comes after a period of strong performance for the tech giant, potentially indicating investors are locking in profits. Google, another heavyweight in the tech sector, experienced a more substantial decline, with its shares tumbling 5% and erasing gains from the previous two trading sessions. This drop suggests growing concerns about the company's future prospects, particularly in light of increasing competition and regulatory scrutiny. Microsoft, a major player in the software and cloud computing industries, also faced headwinds, with its shares falling 3.6%, mirroring Google's two-day losing streak. This decline could reflect broader concerns about the tech sector's valuation and the potential impact of rising interest rates on growth companies. These tech giants' performance underscores the current uncertainty in the market, leaving investors to grapple with the question of whether this is a temporary blip or a sign of a deeper correction on the horizon. Turning our attention to Amazon, the e-commerce giant witnessed its shares drop 4.2% yesterday, closing at $175.20. This decline erases most of its gains from the previous week and brings its 5-day change to a loss of 1.7%. Despite the recent pullback, Amazon's month-to-date performance remains positive at a gain of 2.5%, and its year-to-date change stands strong at an impressive 18.3%. However, after enjoying a 7-day winning streak, Amazon's shares have now experienced losses for 2 consecutive days, Lastly, let's look at Meta platforms. The social media conglomerate saw its shares fall by 3.7%, ending the day at $310.80. This decline marks a reversal from the previous day's gains and brings its 5-day change to a loss of 2.9%. Despite the recent downturn, Meta Platforms has still managed a respectable month-to-date gain of 4.1% and a year-to-date gain of 15.7%. As we can see, the tech sector is grappling with a mix of short-term volatility and longer-term gains. The question remains whether these recent dips represent a buying opportunity or a signal of further declines to come. We'll be discussing this and more with our expert panel right after the break. NVIDIA, a major player in the chip manufacturing industry, experienced a significant decline yesterday, with its shares plummeting 6.8% to close at $114.30. This marks the second consecutive day of losses for the company, adding to the growing concerns in the tech sector. Meanwhile, Tesla, the electric vehicle manufacturer, saw its shares tumble 12.3% to finish at $216. This is also the second straight day of losses for Tesla, wiping out its recent gains. The decline comes amid concerns about increased competition in the electric vehicle market and potential impact of rising interest rates on consumer spending. Tesla's drop is even more pronounced when we look at its recent performance. The company's 5-day change sits at a loss of 14.6%, erasing nearly all of its gains for the month, which now stands at a meager 0.8%. Despite these recent setbacks, Tesla's year-to-date performance remains positive at a healthy 51.2%. However, the question on everyone's mind is whether this recent downturn signals a shift in investor sentiment towards the electric vehicle giant. Turning our attention to NVIDIA, the chipmaker's 5-day performance shows a decline of 3.2%, contributing to a month-to-date loss of 7.5%. Despite these recent losses, NVIDIA has still managed to achieve a remarkable 131% gain since the start of the year. However, with 2 consecutive days of losses, investors are left wondering if this marks the beginning of a broader pullback for the chipmaker. The performance of these tech giants highlights the ongoing tug-of-war between short-term volatility and long-term growth potential in the tech sector. As we head into the second half of the year, investors will be closely watching for signs of whether these recent declines are merely a bump in the road or a harbinger of a more significant market correction. We'll be back with our expert panel to dissect these trends and more after the break. Now let's shift gears and examine the financial sector, which also experienced its share of volatility yesterday. Starting with the credit card giants, both Visa and MasterCard faced headwinds. Visa saw its shares drop 4.0%, marking 2 consecutive days of losses. MasterCard didn't fare much better, with its shares declining 2.1%, also marking its second straight day in the red. Turning to the banking behemoths, we saw a similar trend. Bank of America experienced a modest decline of 0.5%, reversing its previous day's gains. JP Morgan Chase, the largest bank in the U.S., saw its shares fall 0.8%, also reversing 2 days of gains. Morgan Stanley, another major player in the financial sector, experienced a decline of 1.5%, mirroring the trend of reversed gains seen in other financial institutions. Lastly, American Express saw its shares tumble 2.4%, reversing 2 days of gains. These declines in the financial sector, while less dramatic than those seen in the tech industry, suggest a broader sense of caution among investors. The question remains whether these dips represent a buying opportunity or a sign of further weakness to come. We'll be back after the break to continue our market analysis. Let's take a closer look at Bank of America's recent performance. The banking giant saw its shares decline by 0.5% yesterday, closing at $42.20. This downturn reversed the previous day's gains and contributed to a 5-day loss of 4.1% for the bank. Despite these recent setbacks, Bank of America has still managed to achieve a respectable 6.1% gain for the month. Furthermore, its year-to-date performance remains positive, boasting a solid 27% increase. Looking at the bank's 10-day performance, we see a mixed picture with 3 days of gains. However, the recent reversal of its winning streak might signal some uncertainty surrounding the bank's near-term prospects. JP Chase, on the other hand, saw its shares fall by 0.8% yesterday, closing at $148.50. This decline erased the gains from the previous 2 trading sessions and resulted in a 5-day loss of 2.6% for the bank. Despite this recent dip, JP Chase has still managed to achieve a 4.2% gain for the month. Moreover, its year-to-date performance remains positive, showing a healthy 12.8% increase. A look at the bank's 10-day performance reveals a mixed bag, with 6 days of gains. Moving on to Morgan Stanley, the financial giant witnessed its shares decline by 1.5% yesterday, closing at $87.60. This downturn mirrored the trend of reversed gains observed in other financial institutions and contributed to a 5-day loss of 3.1% for Morgan Stanley. Despite this recent pullback, the company has still managed to secure a 2.9% gain for the month. Furthermore, its year-to-date performance remains positive, showing a respectable 7.5% increase. Examining the company's 10-day performance, we see a mixed picture with 5 days of gains. Lastly, let's examine American Express. The credit card company saw its shares tumble by 2.4% yesterday, closing at $156.90. This decline erased the gains from the previous 2 trading sessions, resulting in a 5-day loss of 5.8% for American Express. Despite this recent downturn, the company has still managed to achieve a 1.8% gain for the month. Moreover, its year-to-date performance remains positive, showing a 10.2% increase. A look at the company's 10-day performance reveals a mixed bag, with 4 days of gains. Bitcoin, the world's largest cryptocurrency, also experienced a downturn, with its value dropping 2.5% to close at $64,249.90. This marks 3 consecutive days of losses for Bitcoin, contributing to a 5-day decline of 3.7%. Despite this recent volatility, Bitcoin has still managed a 2.5% gain for the month and an impressive 52% increase since the start of the year. Looking at its 10-day performance, Bitcoin has seen gains on 4 of those days. The recent pullback in Bitcoin's price could be attributed to several factors, including profit-taking after a period of strong gains and renewed regulatory concerns in the cryptocurrency market. As we've seen across various sectors, yesterday's market performance reflects a complex interplay of factors, including investor sentiment, economic indicators, and geopolitical events. While some investors may view these recent dips as buying opportunities, others remain cautious about the market's near-term direction. The question of whether this is a temporary pullback or the beginning of a larger correction remains a topic of debate among analysts and investors alike. We'll be joined by our expert panel after the break to delve deeper into these market trends and discuss their potential implications for your portfolio.